Hello, and thank you for joining us this evening. My name is Simon, and I'm the Chief Business Officer at MYTHEO. Before we start, allow me to provide a brief introduction of MYTHEO. MYTHEO was launched in 2019 to provide automated discretionary portfolio management services, in which we leverage on technology to provide clients personalized, convenient, and affordable way to build their wealth. Our proven algorithm help identify the best investments while keeping risk at bay. Similar to how Theo financially supported his brother, the renowned Vincent van Gogh, an artist that has been striving to achieve his dream. MYTHEO aims to help you achieve your financial goals and enable your moments in life. A quick rundown of today's 1-hour session. It will be carried out in Q&A format with live polls in between. Meanwhile, if you would like to ask the speaker any question, you can interact with us via the Q&A button on the menu bar at the bottom of the window in which this presentation is displayed. I'm joined by Matthew Stuart-Box, the Chief Investment Officer of MYTHEO, where he is responsible for the development of all investment algorithms, portfolio management, and trading at MYTHEO. Besides that, he is also the Chief Operating Officer of Theo Japan, where he is responsible for all investment platform-related teams, including portfolio management, trading, and operation. Last week, the market has taken a turn for the worse, with US stock hitting a new low for the year as market volatilities continues. In today's world, even the savviest investor may struggle to keep track of the rapidly changing market conditions. So how do investors react on time and keep their investment safe? One of the options is discretionary portfolio management, a service whereby investors let the investment manager build and manage their investment portfolio based on a clearly outlined investment policy in pursuit of their investment goal. Before we start, if I may ask a question to our audience. What do you think are the drivers of investment portfolio performance? You can choose multiple choice or single choice. Okay, I should stop here. Let me share the result. So 100% mentioned is asset allocation, while 67% mentioned that it's due to security selection, and 33% market timing, and none mentioned other factors. So all answers are correct. The main driver of investment portfolio performance is actually asset allocation, where more than 90% of the performance was actually due to a good asset allocation strategy. So let us begin. Matthew, what is discretionary portfolio management?
Sure. Okay. Thank you, Simon. Thanks for the question. I'll try and explain a little bit about what discretionary portfolio management is, how it works. So as you mentioned at the start, it's a service where the investment manager offers a portfolio service to the client. So the client gives some directions to the investment manager in terms of how much risk the client wants to take, what kind of asset types he wants to invest in, the kind of investment horizon, how long they want to invest for, those kind of general directions. And then the investment manager uses that information and goes and sets up a portfolio on behalf of the client. So the investment manager will choose the assets and the securities to hold in the portfolio. They will go out and do the trading. They'll go and buy those assets.
Mm-hmm.
And then they'll maintain that portfolio going forward, keep it at its target allocation.
Sure.
I mean, this kind of service obviously is very common in the US in particular, and also in Europe. Traditionally, this is for really quite wealthy clients, and the idea is they can delegate the day-to-day management of their portfolio, so they can focus on something else.
Right.
I mean, so far, it's perhaps been in Asia, at least, perhaps a little less common than in the US. Perhaps maybe in Asia, wealthy people prefer to manage their own portfolio. Traditionally, it's used to be a very expensive kind of service because obviously you're using a manual process. The manager, the investment manager, is generating a tailored portfolio for the client, and so traditionally these services have had relatively high fees and also a relatively high kind of minimum amount, a minimum balance that you have to invest in order to get this kind of service. But the interesting thing is, over the last 5-6 years, through the use of technology, it's become possible to offer this kind of service much more broadly by automating a large part of it. Using computer models, computer algorithms, you're able to automate this process. And this has given rise to a whole new service. People give it different names, digital investment management or robo-advisors. But the idea is using technology to offer a similar kind of tailored investment service, but at a fraction of the cost of traditional discretionary portfolio management. And in our case, we've been doing this business. We've been offering this service in Japan for the last 6 years. We started back in 2016. And then, of course, MYTHEO, we've been live just coming up for 3 years in Malaysia. So we've been doing this for a while.
Yeah, great. So it is a very exclusive option to invest in the market, and it's also not cheap. So, well, I mean, this is one of the options that is available, right? Why would investor want to use a discretionary portfolio management service then?
I mean, it's a good question. I mean, I think people are very aware that certainly nowadays, financial markets are moving very fast. They're global markets. News spreads very fast around the world. Shares, exchange rates, interest rates, commodity prices, they can all fluctuate really quite dramatically, even on a small piece of news. And we've seen this especially over the last few weeks or so, where equity markets can move 3.5% in a day. And so keeping up with that kind of movement, keeping up with those kind of events can be very, very time consuming and really quite difficult. And I think, a lot of people don't want to spend that much time doing that, and so hiring a discretionary manager takes away a lot of that headache, that kind of hard work of kind of constantly trying to keep up, monitoring your portfolio, rebalancing your portfolio, all that kind of thing. You can delegate that to the investment manager. Obviously, as the client, you're not giving up control of your portfolio. The investment manager will follow your instructions. So you shouldn't think of kind of discretionary portfolio management as something that's kind of passive or kind of handing over control. Really, you're delegating the execution of your policy to the investment manager. But essentially, they're there to follow what you want for your portfolio. So it's a way of kind of delegating some of the kind of day-to-day work of managing your portfolio, while you still keep a reasonable amount of control over it.
Yep. Well, I mean, interesting. I mean, the understanding is really at the discretion of the portfolio, but it's also the relationship where it's not really entirely passive, right? It's just a delegation of the execution of the investment strategy, such as monitoring the day-to-day market movement, the portfolio buy and sell, and stuff. So I mean, in Malaysia, right? I think most of people know unit trust. So that has been, the main vehicle that investors used to invest here. So how does discretionary portfolio management differ from unit trust?
Sure. I mean, it's a great question, and it's not just Malaysia. Most countries have a unit trust marketplace. To the US and Europe and Japan too. Maybe if you think about what a unit trust is first, well, it's a commingled investment product, and what happens is the manager of that unit trust creates a pool of assets. They go and buy some assets, perhaps a portfolio of equities or a portfolio of bonds, and then you can choose to invest into that pool, put some money into it, and in return, obviously, you get what are known as units of the trust, which is basically a share in the value of the pool of assets, and the value of those units goes up and down depending on the value of the portfolio of assets that are in the unit trust. So it's very straightforward. And it's a very convenient way of investing. You're pooling your assets and getting a professional manager to manage that pool. I think if you think about how that differs from discretionary portfolio management, really, a unit trust is a single product. So it'll be, for example, an equity fund or a bond fund or something like that. But it's essentially a single product.
Right.
Whereas, discretionary portfolio management is a service. It's an overall service for the client that's generating an entire portfolio on behalf of the client. So you probably wouldn't want to just own one single unit trust in your account. That would probably be a little risky. You'd probably want to own a range of unit trusts in order to make up a portfolio, perhaps an equity unit trust, a bond unit trust, perhaps a commodity unit trust. And in that case, you're going to have to do that yourself. You're going to have to make those choices yourself, decide which unit trust, which equity unit trust you want to buy, which bond unit trust you want to buy. All of those choices, if you don't have a discretionary management agreement, they're all up to you. They're choices that you have to make. Obviously, you could go and find a unit trust that holds a range of different assets, and those do exist. A kind of a balanced fund, a multi-asset fund, a fund that's got equities and bonds and commodities all in one portfolio, and that's a good way of investing. The problem there, obviously, is it's really a kind of like a one-size-fits-all kind of approach. You don't get any choice about what's in that portfolio. The manager of the unit trust will decide what assets to put in, what ratio, and things like that. And everybody who invests into that unit trust gets the same portfolio. So it's I think the main difference there is you're either looking at a kind of a one-size-fits-all kind of product compared to discretionary portfolio management, where you can perhaps tailor or customize the portfolio to the needs of the individual client.
Sure. So you're saying unit trust is a product and discretionary portfolio is a service. So how do investors decide between a product and a service? What are the advantage and disadvantage of DPM, the discretionary portfolio management, have over unit trust in today's market condition?
I think there's probably, I would say there's two big differences really, and one is this element of customization. Everybody's investment needs, I think, are different. Everybody's at a different stage in their in their life. Everybody has a different amount of risk that they want to take, a different investment horizon, different investment needs. And you simply can't do that with a unit trust. You can't customize a unit trust. Everybody gets the same portfolio. Whereas with a good discretionary portfolio manager, they're going to listen to the needs of the client, try and work out what that means from the point of view of a portfolio, and then go out and build something that, as close as possible, matches the needs of the investor.
Yeah.
And obviously your needs might change through time. As you get older, perhaps your risk tolerance might change, things like that. But a good discretionary portfolio management service will grow and adapt with you as your needs change.
Right.
And that's probably something that a unit trust can't do. That's probably the first big difference. And then the second one, obviously, is to do with costs. And obviously, it varies. Not all unit trusts have the same fees, but in general, unit trusts will charge two kinds of fees: a kind of initial sales fee, which obviously depends on the sales company and depends on the unit trust, but it could be 2-3% that's taken out of the money immediately as you put it in. If you put in $100, they're going to take away $2 or $3 right from the start as their sales fee. And then obviously on top of that, there's a kind of an annual charge by the unit trust manager. And again, that can vary, but it's not unusual to have 1.5% taken out every year as the manager's fee.
Yep.
So they can be relatively expensive. Obviously, traditional discretionary portfolio management is expensive. The fees are high. But the good thing with robo-advisor or this kind of digital approach to discretionary portfolio management is by automating it, by using computer algorithms, you're able to bring the costs down way, way lower than a traditional discretionary portfolio manager.
Right.
And, you can end up with costs that are significantly less than you would pay, for example, from a unit trust. So I think this element of being able to customize, but also being able to run your portfolio with significantly lower costs means that in the long run, you've got a better chance of earning good returns, I think.
Right. So, I mean, well, this digital discretionary portfolio management is a very interesting proposition where you can have a customized portfolio at a much lower cost, right? So, well, in Malaysia, there are a lot of discretionary portfolio manager out there as well that runs their offering in digital format, right? So, how do investors choose the right discretionary portfolio manager?
That's a very good question. Yes, yeah, there are multiple services out there, and in some ways, they can look quite similar. They ask a few questions and they'll provide you with a target portfolio. I think there's a couple of things to think about. One is the underlying investment philosophy, the underlying investment process. All of these managers, all of these robo-advisors will have something where they go through and explain their investment philosophy. How do they approach investing? The level of disclosure varies by the manager, but pretty much everybody has something to say about how they approach investing. And I think it's important to spend a little bit of time and read through those and, see if that approach makes sense to you, if it's an approach that you think is a good one, because essentially that's what you're buying as part of this service. Then after that, there's things to consider in terms of kind of how easy is the service to use. As you said, most of these are done online, and so they'll all have a website and an app where you can go in, set up your account, perhaps look at some back tests or some simulations of how the performance might have looked like. Open the account, KYC, that kind of thing, and then monitor and maintain your portfolio going forward. And it's important to have something that's easy to use, clear to use, easy to set up, so you don't have to spend a lot of time kind of worrying about how to find your portfolio, look at the performance of your portfolio. So the ease of use of the service, I think, is an important thing. And then perhaps also, look at the level of customization that you can do in your portfolio. Most services will offer a kind of a recommended allocation or a recommended portfolio based on their algorithm. But a lot of services, they'll also offer the client the ability to customize that allocation, perhaps add a little bit of equity, reduce the amount of bonds, and so on. And perhaps as you get more experienced in investing, you're going to want to do that perhaps a little bit yourself. So you might want to look for a manager that offers that kind of level of customization as well.
Right. I see. Okay, so basically there are a few factors to look for: the investment philosophy, the ease of use, the level of customization, right? So perhaps, if you can help us to understand what are the discretionary portfolios that are offered by MYTHEO at the moment.
Sure. So we offer really two main discretionary portfolios. The first one is what we refer to as the omakase approach. And this really means kind of leave it up to MYTHEO. And this approach is where we will ask a series of questions to the client, really quite simple questions in terms of their age, their income, their investment horizon, that kind of thing. And based on that, our investment model will provide a recommended asset allocation. We can talk a little bit later about how that allocation works. But then you can choose to accept that allocation, and then MYTHEO will go and build a portfolio to match that for you. And then it'll maintain that portfolio going forward. So once you've set up the portfolio, once you've answered those questions, and put some money into your account, essentially that's it. You can just relax. MYTHEO will take care of everything after that. You can see what's in your portfolio, you can monitor it, you can monitor portfolio performance at any time, but you don't have to do anything else after that. And so that's a very attractive course, I think, this omakase course for investors who don't have such a lot of perhaps experience. They're just getting started in investing, that kind of thing.
Right.
So that's one course. But we also enable the clients to customize their portfolio as much as they want as well. And so you can go in and raise the amount of equity allocation or decrease the amount of real asset allocation, and essentially set your own allocation to be whatever you want. We tend to find maybe about 10% of clients choose to do that. And they tend to be clients who have had a little bit more experience. They have a little bit more of a view of where they would like their portfolio to be focused. And that's perfectly okay. Either of those approaches can be handled by MYTHEO.
Sure. So it's not entirely passive, right? The portfolios, discretionary portfolios that MYTHEO offer, they are main portfolio that invest across everywhere, and there's another one which is a more specific satellite portfolio, right? So how does this discretionary portfolio works? Can you share with us more details on how the discretionary portfolio are constructed and managed, and what are the management process and approach that might involve, and what's the investor's role then?
Sure. Yeah. Maybe if I could perhaps share the screen here. Maybe it might be a good way to explain. Okay, here we go. So maybe this is the place to start. This gives a good kind of overview of how we approach this kind of discretionary investment management. And the idea here is Our underlying philosophy is that investors invest for various different reasons. It's not just a single reason to invest. There are various different reasons why somebody would want to invest. And we tend to think of it as kind of three main reasons. And you can see that right in the center here. These three blocks labeled growth, income, and inflation hedge. And this is the real core of the concept of MYTHEO. The idea is, some people will want to invest in terms of aiming to grow the value of their assets over the long term. That's perhaps the most common reason for investing. You want to grow your assets over a long horizon. Obviously, in order to do that, you're going to have to take some risk. Yep. That's the way you can grow your assets in the long term. And so what this portfolio tends to focus on is equities, global equities. That's probably the best way to, in the long term, grow the value of your assets.
Yeah, Matt, if you can share the slide in full screen.
Sorry, yeah, thank you. Thanks. Thanks. Yeah, thank you. So one reason for investing is growth. But that's not the only reason people want to invest. We also think in terms of the need for income. A lot of people invest because they want to generate a regular kind of cash flow from their investments, a cash flow that can cover their living expenses, for example.
Yep.
And so, this might be more appropriate for somebody who is getting close to or has retired. They have a pool of assets, and they need those assets to generate a regular cash for them to cover their living expenses. And that's a perfectly reasonable reason to invest as well.
Yep.
And so naturally, in this kind of case, you're going to be looking more towards investing in bonds. That's probably going to be a better way of generating a regular cash flow. Less risk, lower returns in the long run, but more stable returns.
Yep.
And then the third reason we can think of for investing is this one labeled in inflation hedge. And the idea here is that, if you have some assets, then you probably want to protect the value of those assets. In particular, you want to protect them against inflation. Obviously, as prices go up, the value of your assets, the real value of your assets, goes down in terms of what you can buy with those assets. And so one reason for investing is to try and hedge against that inflation, to try and increase the value of your assets, at least in line with inflation. And again, that's a perfectly valid reason to want to invest.
Yep.
In that case, you're going to want to invest probably in real assets, things like real estate or commodities, gold, silver, that kind of thing. Those things tend to move very closely with price inflation.
Yep.
But the idea is, any individual will have a range of needs for growth, income, and inflation hedge. And that ratio of their needs is going to be probably unique to that person. And so what we try to do at MYTHEO is assess the needs of the investor. How much growth do they need? How much income do they need? How much inflation hedge do they need?
Right.
And then go and build them a portfolio that has that allocation across these three kind of investment objectives.
I see.
So I think this approach is one that's, I think, unique to MYTHEO. I'm not sure I know of any other robo-advisors that offer this kind of approach to investing.
Right.
But I think it's a good way of making sure that the portfolio is really tailored to the individual needs of the client.
Sure. So each client would have a portfolio which consists of three functional portfolio, right? So the difference is that the ratio would differ between each investor based on the answer that they have provided.
That's right. Yes.
Right. Okay. Great. So so a question for our investor. Okay, which one has performed better, ETF or unit trust? So first answer is ETF, second answer is unit trust, third is it depends. Okay. Let me share the result. So we have 50% of our audience choose it depends, while 40% choose ETF, and only 10% choose unit trust. That's correct. The answer is it depends. ETF are actually meant to track index, such as S&P 500 index. In a more efficient market like developed market, such as US, Europe, and Japan, it is difficult for unit trust to outperform the market. And study has also shown that indices have largely outperformed actively managed funds during the long bull market over the past decades. So the question to Matt, where will MYTHEO be investing and how is it being invested?
Sure, thank you. So the answer is all of our client assets are invested into ETFs. There's a number of reasons for that. As you said, these ETFs are designed to track certain groups of assets, certain indices. And so they're a very efficient, cost-effective way of building portfolios for clients.
Right.
The ETFs that we use are all large ETFs that are listed in the United States. And the reason for that is simply because that's where the biggest range of ETFs is. And that's where the cost of trading the ETFs is the lowest. Obviously, although they're listed in the US, the ETFs themselves hold assets that are global assets in nature. So they're not all US assets in those ETFs. Right. We have exposure to the US market, to Europe, to Asian markets, to emerging markets as well. It's just the ETFs themselves are traded in the US. I think, most people have heard of ETFs, but it may be just worth just mentioning just briefly, really what they are and why they're so useful. So ETF stands for Exchange Traded Fund.
Right.
And so these themselves are funds. In a way, they're very similar to mutual funds in that they are pools of assets. But the difference between a mutual fund and an ETF is, in the case of the ETF, the ETF is listed on an exchange. And so this means that the ETF can be bought or sold at any time for a very low commission, very, very low cost. And so this enables managers like us to immediately invest money that a client gives us. We don't need to wait or anything like that. We can immediately go out and buy the ETFs on behalf of the client. Right. And so this gives a much better liquidity, a much easier way of building the portfolios for clients. This ETF market has grown hugely over the last 10, 15 years. Nowadays, there are well over about 8,000 ETFs listed globally, with trillions of dollars included in those ETFs. The way we use them for MYTHEO is we screen those ETFs, select the ones that have the lowest costs, the most liquidity, and provide the best exposure to growth income and inflation hedge.
Mm.
That gives us a universe of, as it shows on here, 59 ETFs split between these three portfolios.
Mm.
And we use those to build the portfolios for the client. Yes.
Okay, thanks. So, so ETF are the vehicle that MYTHEO used to invest in. In fact, it's a portfolio of ETF. So there must be risk, right? So what are the risks involved, by having this investment?
Sure. I mean, with any investment product, obviously the biggest single risk is market risk. You're investing in perhaps a range of different markets, equity markets, bond markets, commodity markets. But the risk obviously is that the markets fall. And markets are volatile, and particularly right now, there's a lot of volatility, a lot of uncertainty out there. And so the main risk is market risk. The stock market could fall, bond market could fall, commodity markets could fall. The real danger here is obviously if these all happen at the same time.
Yeah.
Normally, you'd expect perhaps if equity markets are falling, perhaps bond markets are doing well, or if commodities are doing well, then perhaps bonds are doing badly. So normally, there's an element of diversification amongst these between the different asset classes, between equities and bonds and so on, but also within each asset class. And perhaps the US market is doing very well, but the European market is not doing so well, or something like that. And so, although all of these markets can go up and down, normally you'd expect some markets to be going up, some to be flat, some to be going down. And so the overall risk to your portfolio is that much lower.
Right.
Obviously, there are times when investor sentiment turns very negative, and a large number of markets fall at the same time. We have, within MYTHEO, we do have an approach to try and manage those risks as best as possible. And we have a AI-based model, which we call the AI Assist, which aims to try and manage some of these downside risks. And this is a proprietary model that we built for MYTHEO. And the idea behind it is, we're not trying to predict returns or things like that, but we can use AI to flag up particular markets where the risk in that market is much higher than normal. And so we saw, for example, at the start of the COVID pandemic, several markets, several emerging markets, in particular markets, for example, in Latin America, Brazil, places like that, showed extremely high levels of investor risk, investor concern, things like that. And our AI model picked up on that and shifted our portfolios away from emerging markets, away from South America, towards other markets, which, while they were still affected by COVID, perhaps had perhaps less of a downside risk. So, there's no way that AI can eliminate that risk completely. If you're investing, you're going to have some market risk, you're going to have some volatility, and that's inevitable. But there are ways you can try to minimize that risk and ensure you don't take any kind of unnecessary risks there.
Well, it will be a lot of, comfort to know that there's this AI that is monitoring the market and actively trying to reduce the risk of large drawdown in a portfolio, especially in the market that we're seeing today, which is highly unpredictable. So a question to our investors. How often do you review and rebalance your investment portfolio? Okay, let me share the result. So most of you chose quarterly to rebalance your investment portfolio, while we have monthly and yearly at the same time. Investing is one thing, right? So maintaining it over time is another thing. So what are the portfolio maintenance that MYTHEO does to ensure that our portfolios stay relevant?
Thank you. I mean, this is a very important question. You don't just build a portfolio and leave it alone. That would be a very dangerous thing to do. So maybe I can perhaps explain a little bit about how we approach it for MYTHEO. Perhaps maybe down here is a good way of showing it. And so the point here is there's a series of processes that we use to maintain your portfolio. These are done all done completely automatically. The client doesn't have to do anything to trigger these. They're all done automatically for all of our clients.
Mm-hmm.
And really what they're doing, all of this is doing, is trying to make sure that your portfolio is kept up to date at its target and reflecting the current market situation and your needs. And so if we kind of go across the list here, if we start on the left hand side, what we call rebalancing, and so this happens every month, and this means moving your portfolio back to its original target. Obviously, during the month, as the markets move, your portfolio will gradually move away from its optimal target. And so once a month, we, for all of our clients, move them back to their original target.
Right.
Then, depending on the portfolio, monthly or quarterly, we review the allocation within the portfolio. So, for example, within the growth portfolio, we have ETFs that are US-based, Europe-based, Asia-Pacific, emerging market ETFs. And once a quarter, we use our investment algorithm to recalculate the optimal, the best weights to apply to that portfolio. What percent should we invest in the US? What percent should we invest in Europe? This is what we call reallocation. That again is done automatically for all our clients at the same time, normally once a quarter. Then on the right-hand side, we've got a couple of steps that happen annually. We call these recreation and reprofiling. Oops, excuse me. Recreation and reprofiling. Recreation is simply updating our portfolio allocations to take into account the market situation over the last year or so. And so this takes into account the fact that correlations between assets do change through time, volatility levels change through time. You don't want to update this too frequently, otherwise you're going to always be moving your portfolio around. And so we've found that updating that kind of information once a year is probably best. And then finally, reprofiling. This takes into account, each year we get older, and as we get older, the level of risk that we should be taking in our portfolios, our investment horizon changes, and as a result of that, our optimal asset allocation changes for each client. And so we automatically update all of our clients once a year to reflect that. So this is a kind of an automated process, but it just makes sure that your portfolio is always up to date, always reflecting what's been going on in the market and reflecting your own condition.
Right. So I think this does create a lot of value for investor. as this are being done on a very regular basis and without fail. Would you be able to share with us what have been the rebalancing and reallocation that we have done recently, especially in the midst of the market volatility?
Yeah, sure. Yeah. So I can give you an example of kind of how this, in particular, the reallocation has worked. And so this is from our growth portfolio. This is from our equity portfolio. And we reallocated at the start of this month. And so you can see we have on the left-hand side some ETFs which we included into the portfolio. And on the right-hand side, some ETFs which we sold out, closed our positions in the portfolio. And a couple of things to point out. If you look on the ones that have been included, perhaps, we start there. The third one on there, this Russell Mid-Cap Value. So this is a US equity ETF, investing into value stocks. And I think, as many people know, growth stocks, particularly in the US, have been struggling recently. They've become more volatile than they've been in the past. And so part of this reallocation was picking up on that and moving to value stocks, which have tended to outperform and have had lower volatility recently.
Right.
Now, on the flip side, in terms of things we exited, you can see we exited 2 European ETFs, the Eurostoxx 50 and MSCI Germany. And our model doesn't explicitly include kind of geopolitical risk and things like that, but certainly the conditions in Ukraine and Russia, related particularly to energy, have had more of an impact, I think, on European economies than perhaps the US. And so we've seen Germany, European equities to be a little bit more volatile than certainly they've been in the past. And so our model picked up on that and exited those kind of positions.
Right.
And then the other part, you can see within Asia, we reallocated towards India and South Korea and away from Taiwan and Singapore. I think certainly in the case of India, this is a market that actually has come through this recent volatility relatively well, surprisingly well. I think it's a function perhaps of its as an economy, it's not particularly exposed to Russia, and it has obviously a strong kind of tech element to it, which has done very well recently. So we've moved into India, but if you look at the Asian markets that we've exited, Taiwan, Singapore, in particular. Somewhere like Singapore, the market there has a very strong exposure to real estate, and obviously in a rising interest rate environment, real estate stocks have been struggling and they've become more volatile. So I think that's part of the reason why we exited that position.
Right.
You can see, each quarter we're updating our model, and our model is moving the portfolio. They're not huge changes. It's not churning the entire portfolio. There's large parts of the portfolio that didn't change as a result of this reallocation. But it is trying to keep up to date with the market, up to date with changes in volatility, things like that.
Great. Thanks for sharing that. So, I mean, as an investor, right? So what information will they receive from MYTHEO to keep them informed of their investment portfolio?
Yeah, so maybe we can go back up to here. Once you've set up your account in MYTHEO, we'll show you obviously the target allocation that you've got. You'll be able to see kind of the historical performance of that portfolio, and then you can obviously also see exactly what ETFs are included in your portfolio at any time. So you can see that either on the website or via the MYTHEO app. You can immediately see exactly what's in your portfolio. You can see the value of your assets, the performance since you opened your account, And then also, any history of deposits, withdrawals that you made into the account.
Right.
All of this stuff is, available to you at any time, so you can see what's been going on in your portfolio at any time.
Right.
And then also, more generally, once a month, we publish some commentary on how each of these three functional portfolios, the growth, the income, inflation hedge, how they've performed over the last month or so. That will give you some commentary about, what we hold in the portfolio, what's been doing well, what's been doing badly, that kind of thing.
Yeah, great. So, we have two questions from the audience. First question is: in future, will MYTHEO offer flexible portfolio with discretionary service management?
Yes. So this is a good question. So there's an element of flexibility at the moment. So a client can go into their account, and if you see these percentages here, the 40, 34, and the 26, the client can go in and change those percentages. And so that allows the client to tailor their portfolio to an extent. We don't allow the client to select the ETFs that are included in the growth portfolio, or the ETFs that are included in the income portfolio. I think the answer there is selecting those ETFs involves an awful lot of risk. And in order to ensure that your portfolio is properly balanced, the proper kind of risk characteristics, we don't allow clients to select the individual ETFs in their portfolio. Right. Having said that, going forward, we could easily offer some additional ways to customize your portfolio. Last year, we started to offer an ESG-based growth portfolio, which has similar kind of return and risk characteristics to the standard growth portfolio, but it's investing into ESG assets, ESG companies, things like that. And clients can choose to open an additional account and put an allocation into the ESG growth account. I think going forward, we'll probably offer some more different versions of perhaps these functional portfolios, right, and allow customers to select the version of that functional portfolio that they feel most comfortable with. Understand. Right. Okay. Second question is, based on the current market, all robo-advisors are only dealing with ETF. Will MYTHEO be having an AI that run portfolio based on unit trust? So they will be the only person in the market to do so. That's a very good question. It is something that we certainly are looking at. I think I can say that. Our investment algorithm right now, as you say, we run it solely on ETFs, but there's no reason why our algorithm couldn't work on, as you say, on mutual funds, or even on individual stocks as well. From the point of view of the algorithm, it's simply trying to find the best combination of assets to meet a certain objective. And so from that point of view, there's no reason why it has to only be ETFs. Having said that, ETFs do have quite a lot of advantages in terms of costs and liquidity, things like that. So I think perhaps where you could see robo-advisors wanting to use mutual funds might be where quite specialist portfolios where there isn't an appropriate ETF, or the ETF exists, but it's really quite small and it's not very liquid, or something like that. Right. In those cases, then it might make sense to get that exposure via a mutual fund instead of an ETF. So I wouldn't say that we are completely locked into using only ETFs.
Yep.
I think, if there was a situation where using a mutual fund was the best way to provide that exposure to our clients, then absolutely, yeah, we would be open to using mutual funds, yes.
Yep. Great. So, there's one more question. So looking at the current circumstances where we have seen volatilities in the recent months, should we invest now, or we wait until the outlook is clearer?
Yeah, I mean, that's I'm glad that question came up. I mean, it's obviously the big question that a lot of investors are worried about right now. And it's true, the economic outlook, the political outlook is unclear. We've seen a lot of volatility, and there are a lot of potential risks to asset classes, both geopolitical risks, and also economic risks. Nobody knows what's going to happen with inflation and interest rates going forward. But having said that, a lot of that uncertainty is already priced into the market. The stock market has fallen. The US stock market has fallen just nearly 20% from its peak. Interest rates in the bond market have gone up to over 3% in the US. And so a lot of this stuff is already reflected in asset prices. And so although it's very tempting to think, well, I should wait, see how things turn out, wait until there's a little less uncertainty before I invest. But the fact is, if you wait for that, you'll probably miss out on a lot of the rally of the market. We've seen that, the market can rally really quite quickly on positive news. And there's a very big danger of sitting out and waiting could mean that you could miss, the first half of any potential rally before you get back into the market. So I would say, trying to time the market, trying to guess where the bottom is, and trying to get in there is something that's extremely difficult. There are very, very few people who can do that consistently. The best way is to stay invested, add to your investments regularly. This idea of dollar cost averaging is a very strong one, especially when markets are volatile. But keep invested, keep your portfolio up to date, but don't try and time the market would be my advice. Yeah.
Right. Great. So our audience seems to agree. The good answer is always buy when volatile. So, right. So allow me to share the key takeaway for today's session. So we talk about the discretionary portfolio management. So the fundamental objective of portfolio management is actually to select the best investment option as per one income, age, time horizon, and risk appetite. So using a discretionary manager takes away the headache of constantly monitoring your portfolio, as it means that the manager, rather than the investor, take the decision on what to buy and sell. And MYTHEO discretionary portfolio proprietary algorithm will propose, manage, and invest your portfolio based on only 5 questions, such as age, income, time horizon, risk appetites, amongst others. Each personalized portfolio will consist of a diversified basket of equities, fixed income, and real assets. These are carefully chosen from more than 8,000 ETFs globally. A well-diversified portfolio helps to minimize the overall risk associated with the portfolio. A MYTHEO algorithm or artificial intelligence will automatically rebalance and re-optimize the portfolio regularly to ensure it still matches the client financial goals and risk tolerance. So with MYTHEO handling the E to Z of investing, you just need to sit back and relax. So that concludes the session that we have today. So thank you, Matthew, for sharing with us your insight on discretionary portfolio management. And thank you a lot to our audience as well for your participation and your attendance today. So we look forward to see you again in our next webinar in June. So thank you, everyone. Have a good night. See you again.
Let's take a moment to talk about money. We all know how important it is to save. But no matter how hard we work to build our nest egg, experts believe most of us still won't have enough to retire comfortably. Investing is the better way to grow your wealth, but requires years to master on your own, or high fees and starting capital to hire a wealth manager. Now, there's an easier way for you to invest. MYTHEO is a digital investment manager that does the work for you using investment strategies with a proven track record, helping over 60,000 Japanese investors grow their wealth. That's over $300 million of assets under management. And this is all it takes to start investing meaningfully. When you create an account, MYTHEO will want to know you a little better. Things like your age, assets, and appetite for risk. Once it has collected enough information, a professional investment portfolio will be generated just for you. This portfolio will consist of ETFs listed in the US stock market. Each ETF is selected for its different feature, such as country or asset class, to further diversify your portfolio, and that disperses some of the risk. This global diversification strategy is one way MYTHEO optimizes your portfolio. The algorithm that drives MYTHEO's logical investment reasoning is based on the research behind 2 Nobel Prizes. In the past, you or your fund manager would have to closely monitor the market's various moving parts every day. That's a lot of data and decision-making. With MYTHEO, you don't have to sweat the hard stuff. It automatically rebalances your portfolio to its prime investment position. What MYTHEO does for your portfolio is no secret. View the rebalancing data anytime from your account, accessible via the app or website. You might even want to start calling the shots one day. Go ahead and adjust the portfolio to suit your needs. After all the money talk, here comes the money talk. Thankfully, MYTHEO's service will not break the bank, just a small fraction of your investment. With no sales fee, no exchange commission, and not a single surprise charge. So the question to ask yourself is this: will it be worth it? Deciding to invest may mean new commitments and lifestyle adjustments. It could also mean the freedom to do what you've always wanted, not just life's milestones like marriage, kids, and retirement, but the moments in between that make life richer. Whatever it looks like, it's time to invest in experiences that truly matter to you, because life's moments are priceless.